So why should accounting firms be experts at 80/20? So accounting is a practice that is based on data and numbers. Unfortunately, most people are not numbers people, so accountants have an opportunity to position their services in a way that few business owners think about. If you think about your whole life in school, most of the time we're graded on a bell curve. And when most people think about the world, they think about the bell curve and it's distributed equally. Unfortunately, that's not really true. If you think about it, the people that were really the top-notch students in your class were usually 10 times better than the average student. They just were not a few percentages better as a curve would indicate, but actually 10 times better. The world is actually quite skewed, and in the 1600s, Wilfred Pareto defined the 80/20 principle when he realized that 80% of the land was owned by just 20% of the population. Now, most people have heard that, but they also don't realize that he also found that 80% of his peas came from just 20% of the pea pods. So this is a generalized principle, not just about wealth and money. Now, there's lots of people that go around complaining about fairness, the Occupy Wall Streeters who are trying to bash the 1%. But you can do your clients a favor if you remind them that 80/20 has ruled and always will rule the world. See, most everything is skewed. Look at your closet. You wear just 20% of your clothes 80% of the time. If you look at your clients, 80% of their profits come from 20% of their customers or 20% of their product line. 80% of customer complaints come from just 20% of the customers. 80% of warranty claims come from just 20% of the defects in the products. 80% of your clients' customers' traffic comes from 20% of traffic sources. If you look at Warren Buffett, 90% of his wealth comes from just 10% of his investments, which is even less than 10%. 90% of the tax audits are caused by just 10% of deductions taken. If you look at political donations, 90% of them come from just 1% of the population. So the world is heavily skewed. 80/20 is a law of nature. And if you ever read Adam Smith in The Wealth of Nations, he spoke of the invisible hand of the marketplace. The reason he did that, and the reason that's related to 80/20, is that 80/20, it's not the exact number 80/20 that's the rule. It's the principle of positive feedback. When a behavior is rewarded, it produces more of the same. So you have to look at the world in terms of how that works. So what that means in terms of your clients. Your clients can find a product or service that they offer or a customer segment that can produce 4 times the revenue of their average customer. Or you can teach your clients that 80% of their sales will come from 20% of their marketing efforts or 20% of their salespeople. If you think about it, that means that your top salespeople are 16 times more valuable than the remaining 80%. So if you're thinking about compensation for employees, people that produce 16 times more than the average or the others really should be rewarded at a higher value. This means there's amazing leverage in focusing on the 20%. It's a whales versus minnow effect. If you think about the world this way, you will produce much more in the terms of results. The other thing that's really interesting about 80/20, it's a fractal principle. That means within each 80/20 distribution, there's another narrower 80/20. If you look at the world, there's 196 countries. 20% of those have 80% of wealth. And within those 20%, you'll find that there's even a smaller portion that, again, has 80% of the wealth. You could look inside the U.S. Again, income is distributed in this, 80/20, even more 90/10 way. You can even look at inside that, the list of the Fortune 500 wealthiest people. There's an 80/20 curve. You pick the top 20% of those top 100, the Fortune 100. Again, you'll see the same 80-20 distribution within this. So that's 80-20 within 80-20 within 80-20. That means that for 80-20 squared, 4% of the input establishes 64% of the results. Suppose you're someone that manages roads and tries to figure out what to do maintenance. 4% of the roads is where 64% of the traffic is. 80-20 cubed means that 52% of the output depends on just 0.8% of the input. Again, for someone that manages roads, half of the traffic is on only 0.8% of the roads in a given area. So this is amazing thing if you think about looking inside 80-20 fractal areas. Sometimes the skewing is even more extreme than 80-20. As I mentioned, it's just not 80-20, it's just not those numbers, it's the skewing principle. The populations of China and India are way beyond 80-20. If you look in advertising using Google AdWords, anybody that's looked into that very carefully realize that it's 95-5 or more extreme. Typically, Google will tell you to, use 800 or 900 keywords when you set up your account, and it turns out maybe 10 to 20 of those keywords produce 95 or 99% of your results. And so it's very important to always be focusing on the highly leveraged area. You look at just the people you know. The average person knows 634 people, but maybe has 2 to 3 close friends. A skewed distribution. So as an accountant, what areas should you focus on? First, how about segmenting your customers' client database, their database? What customers can he sell 16 times more to or charge 16 times higher prices to? If you have a client that will pay you $10,000 a year, there's probably people, if your clients pay you $10,000 a year, there's people in that database that will probably pay you $100,000. You can segment product offering. Is there a few of your customers' product or services they should focus on and cut others? I think the whole principle of brake shops was that brake jobs were probably the most profitable of all mechanic jobs. Is there something in a product offering that is way more profitable than all the other tasks? Then maybe you should eliminate the ones that are not profitable and focus on just the ones they are. You can segment your sales personnel. What are the 20% that are producing 6 times more than the others? Time management is another area where 80-20 rules. 80% of the tasks that most people work on are very low value. Delegate those and focus on high value tasks. Are you as a CEO or your customers, your clients, are they focusing on the $1,000 or $10,000 per hour tasks, or are they dawdling around doing $15 an hour tasks? Have to talk about these things. Time management is really not about getting your schedule right. It's really about focusing on the 80-20. In a tax audit, you can look at and to teach your clients what are the 20% of documents that's important to do correctly so you don't get audited. Expenses. There's an 80-20 of expenses as well. Oftentimes there's some small percentage of expenses that have a much larger impact that can be cut with almost no impact. Okay, cash flow. Are there 20% of the accounts receivable that are causing 80% of cash flow issues? So can you think of more examples in your accounting practice that you can teach your customers? If you can, post them below, and we can all learn from each other.